I think in Fund 1, we approached more than 600 investors, and then we got 80 or 90 of them on board. So roughly, let's say 15% hit rate, which is not too bad, I would say. Not too bad.
Yeah, no, that's great. That's great. I love stories like this where, you went after 600 investors, that just to give people some understanding of what it really takes.
Yeah,
So,
true. True. Well, I wasn't thinking when I started out that I would go for 600.
yeah.
And then, but then at the end, I was looking at the numbers. Wow.
Yeah, that's a lot. Like you said, 15% hit rate. That's actually pretty decent.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and FundingStack.com. Today I have Rando Rannus of Siena Secondary Fund coming to us from Tallinn, Estonia. How's your day going in Estonia?
Hi there. Greetings from Northern European country to all of you around the world.
Very good, very good. Good summers. I imagine summer in Estonia is pretty lovely.
I can't complain. Much better than the dark winter here. So now the daylight is much longer than in the wintertime when you have like 6 hours of daylight. Now we can enjoy double of that.
Good, good. It's on my bucket list to go to Tallinn. I haven't been there. I might take my kid this next summer, so we'll see. I might hit you up for some ideas. But let's just jump into this. What is Siena Secondary Fund?
Siena Secondary Fund is a VC direct secondary fund. So we focus on doing direct secondary transactions with the founders, employees, or early investors in late stage scale ups from the Nordics or Central Eastern European countries. So the companies that we are focusing in needs to be originated from the region we are based, and they need to be really large enough. So we're looking at the companies at least 10 million annual revenue, growing 50% or faster. Usually these are like in tens of millions or hundreds of millions. Our smallest company revenue-wise in the portfolio is exactly 10 million. The biggest one is 2 billion. So you can see it's quite wide range. Valuation-wise, we're looking at 100 million plus companies, and we want to see that there's a kind of an exit horizon already somewhere there. So the whole value prop is basically we want to provide liquidity for those ones who have been there for some time already. So I think everybody already knows that it's a common knowledge that the exit horizon is getting longer and longer. And I mean, 20 years ago, Google, I think, went public in 4 or 5 years after launching it. Nowadays, we're hearing Klarna coming to do an IPO. I think they are 17 years old or so. So it's you need to be really patient to wait for till the final end. So we're basically solving the problem that in the halfway we can provide liquidity for those ones who have kind of back the company from the beginning, and then if the company is doing well, we're happy to take a risk and to kind of wait till the final end.
Yeah, really interesting. For anyone who's not familiar with it, let's define what a secondary is and how are you different than just a late stage investor. Let's kind of get
Sure.
some basic
Sure.
definitions out here. Yeah.
Sure. So we don't provide a primary capital to the company. So the money that we provide, it doesn't go to the company. It goes to the existing shareholder. So like I said, it can be a founder, it can be an employee, ex-employee, it can be early investor. So we kind of recycle the capital, or recycle the shares. So no new shares are issued, and that's the whole logic there. From the underwriting perspective, we are a bit similar to the late stage, but we need to take into account kind of other risks as well, like pref stack, and especially as we're typically buying lower ranking shares than the late stage investors. And what else is different is that as our kind of ticket that we deploy, we're usually doing 1 to 5 million. So we have less than 1% ownership in the company. We want to see some info rights, but we don't get into the board. We don't kind of intervene with the company. So we need to be comfortable with the whole dynamics in the board, in the investor base, and we need to see that, okay, the company is moving in the right direction. That's kind of important for us.
And typically, are you buying these shares from employees or from early investors, from angels that maybe want to get out, or, a combination of all the above?
It's a combination of all of the above. I mean, when we started out 5 years ago, I think the GPs, other VCs, weren't so kind of willing to consider selling. But what we have seen in the last 2 years, there's a kind of mentality shift going on, and I think it's coming from the LPs pressuring their GPs to kind of provide DPI earlier, so they're ready to kind of sell a bit from their best assets. So I don't think it's a bad thing to kind of sell if it's doing well, like sell 10% of the position. So if everybody can get some tangible cash, it's a win-win for all parties. But if we look at the whole number of transactions, then indeed we have done more transactions with the founders, employees, kind of physical persons, I would say, than the institutional investors so far, at least.
Yeah. Is there a bit of an adverse selection problem here? I mean, I understand the value. Like if you're an early investor, you're a venture fund that maybe you did seed stage investment in a startup that's now, scaling pretty rapidly. Maybe you want to, it's your first fund, you want to get some liquidity so you can, pay back your LPs and things like that. I get that. But isn't there a bit of an adverse selection if you as the early VCs have all the information rights, they really know this company, they know the inside, wouldn't they probably want to sell some of their lower performing ones or ones they don't have quite as much confidence in versus their very best deals? Do you understand what I'm saying?
Yeah, true. That's why we haven't done so many deals with the VCs as well. But like I said, the mentality is shifting a bit, and what we're seeing is it's shifting in the last 2 years. So, we need to be cautious, definitely. But the numbers don't lie. So if you look at the numbers, we see that if it's not performing so well, or there's some other risks, or the GP wants to sell 100% of the position, there's like, okay, maybe it's not the best thing to buy.
Yeah, that makes sense. Do many companies allow their employees to sell their shares freely, or do they put in measures to prevent that? Or, in other words, you're often buying from the employees, often probably the early employees, who have pretty sizable stakes. Like, do they have restrictions on selling, or can you kind of go with them? Yeah.
So I mean, we don't want to do any kind of a behind the scenes transactions. So we want to be in good relationship with the management and the board and the founders. So usually we have a kind of a chat with them and get their kind of blessing. The separate question is whether the company needs to be officially involved. That's another topic. I mean, it can go to the kind of legal matters more about it, and it depends on where the company is headquartered. Especially in the US, you have different restrictions there. But the most important is to follow the governance and the typical shareholder agreements. They have the ROFR rights, tag along. Typically there is a different regulation for if it's ESOP kind of shares, then the ROFR rights are usually with the company. If it's some other shares, then some other shareholders might have it. So it really depends case by case. So there's always some kind of regulation, and you need to follow that.
Yeah, I get it. Let's talk about a typical scenario. Do you guys, maybe your deal sourcing process, do you identify, hey, we like this company, it's clearly performing well, it's in our thesis of, Nordics, geography-wise. Do you approach the company? Do you approach the early employees? Like, how do you sort of get your foot in the door to buy these shares? Yeah.
So first of all, I mean, you're totally right. So we have the kind of wish list. So we have mapped out in our region. We have more than 250 companies already mapped out that are interesting to us. We put the priorities, and maybe 50, 60 of them are more interesting for to dig deeper. And then what we do, we do direct outreach to the founders. We talk with the main GPs there who have been the first investors, and these are typically from our region as well. So we know the fellow VCs, and we have a chat with them. We know, well, we have a lot of LPs from the startup ecosystem as well. They have invested into some companies, so it's a I would say the region here is similar to what you have there in Silicon Valley. So everybody's related to everybody, and you need to kind of mingle. You need to build a relationship, I mean, especially in the beginning, 5 years ago, we had to kind of introduce the whole concept of secondary. Nobody knew what it means, but now we are already known. The name is known. We are getting more inbound kind of leads as well. So yeah. So I would say that relationship building, mingling is the most important. Doing outbound, but we're getting inbound stuff as well already.
Yeah. And is the pitch to the company, and frankly, maybe to the employees as well, is the pitch mainly, hey, you've been locked up, your shares have been locked up for 10 plus years in some cases. This gives you some liquidity so you don't have to, so you can buy a house, do whatever. I mean, what's the pitch you kind of go in with? I can see
it's definitely one of the topic, especially if the founders or the top employees, they have been there long, like you said, 10 plus years, and I mean, you want to motivate them. The VCs want to motivate the founder. The founder wants to motivate the top employees. So otherwise, the option scheme is just a paper. It's nobody believes in that. But if they see that the real cash is coming, the people are changing their lives based on that. They start to kind of thinking about it. And we see that a lot of companies already here are using that for the employer branding purposes. So and they are attracting better talent because of that. So yeah, definitely, this is one of the reasons.
Is that the main reason? Are there other, big parts of your pitch that I'm probably not even?
No. I mean, there's other reasons. I mean, what we have said that, I mean, sometimes the cap table might be messy, so you need to clean up the cap table. Some of the angels who have done, I don't know, 100x on their position, they want to invest into new companies, so they need to cash out for that purposes. So there's some other investors, they want to rebalance their portfolio. So there's like different reasons for doing that. So it really depends on the stakeholder.
Would your pitch as coming in as a secondary buyer be more compelling if the company still appears to have a long time until it's going to go IPO? I mean, if I'm thinking if I'm in the employee's shoes, if I think this is going to go public in the next 2 years, I probably want to sit and wait for that potential, Figma type of pop, right? Is that part of it too? It's like, these long time horizons until IPO is a big reason why maybe I want to sell some of my shares early or
that's one thing. But even if you're thinking that it can go public in 2 years, then you never know what's going to be the rules for, when you can sell, actually. So it might be that the first day it pops, then kind of starts to fade out the price. We have seen the fluctuations happening, so maybe it's wise to sell off a bit. That's one of the reasons, and we have seen. I mean, in the last years, for Klarna, again, good example. Max valuation was $50 billion US dollars. Now there's rumors that it's going to do IPO at 13 billion. So it's not that it's always going up. You need to think of that there might be negative scenarios as well. So I think the wise investor would think of kind of like I said, partially liquidating and kind of getting some kind of let's call it a dollar cost averaging approach.
Yeah, kind of lock in some gains now and then save some and hope for the. Yeah, that's a good point. I guess not all company valuations continue to go up and to the right. Sometimes
Exactly.
they go sideways or even down
Exactly.
before IPO. Yeah.
Exactly.
Very interesting. And then, I guess part of this, the secondary concept makes a lot of sense when IPO, when companies are taking a long time to go IPO. But I remember, I was around during the first dot-com bubble when companies were going IPO like overnight, a ridiculous
Exactly.
short time frame. If the market returns to that faster time to IPO, does your business model sort of I don't want to say collapse, but does it sort of have a pretty big impact, if the time to IPO decreases a lot?
Uh, I don't think it will happen so much. I mean, like we saw in the .com bubble. I mean, what we might see again, what happened a few years ago, that the valuations climb up really fast. And in these kind of scenarios, what we need to do is we need to be patient. I mean, we shouldn't rush into the deals too fast. We need to have the sanity check about the valuations. I'm not saying that we haven't done mistakes. Of course we have. But we are kind of learning on the way as well. So yeah,
Yeah.
I think patience is the best thing, and then that's why we love to build a relationship with the companies already early on, so that we can kind of monitor how they're doing, and maybe not to do the deal on the first when the first opportunity comes on table, but maybe in the second or third one. So our kind of some of the deals what we have done have taken 2 years. I mean, from the first initial contact. So
Yeah.
you don't need to rush. That's the thing.
That makes sense. And so the pitch to the companies you're looking to get into, giving some liquidity to early employees, also early investors. The pitch to your LPs who funded your fund, I imagine it would be something like, hey, we're getting in on these IPO track deals at good valuations before. Is there more to that pitch?
There's more. There's
Yeah.
more. I think. I mean, I wouldn't say that we are the typical pre-IPO investor who is like, okay, in 2 years you can get your money back. I would say we are like pre-IPO investor. So we want to keep our fund life cycle is 7 years, investment period 3 years. So the first exit should come in year 4 or 5, which is already two times less than the typical early stage investor would see. So I think the first value prop for the LPs is that is the shorter cycle, and the kind of getting cash back faster. That's one of the things. And the second thing is the risk return profile. So in the early stage game, it's like out of 10 investments, 8 go to bust and 2 need to deliver the whole fund. We are kind of putting it vice versa. So 8 should deliver steadily, maybe 2 of them not delivering so well. And if you compare the overall results, the IRR, the DPIs, the DVPIs, etc., it's actually the same, or sometimes even better in the secondaries than in the early stage VCs. Because in the early stage VCs, it matters. I mean, which GP you're backing, because only the top 10% of the VC funds will deliver the best returns. In the secondaries, there is only 1% of the funds who will not deliver a 1x back, compared to the early stage investing where it is 25%. So you're basically quarter of the chance that you will lose your money, compared to the 1% chance. So if you look at our LP base, we have more than 100 investors in our funds. The half of them had not invested into the VC before at all, or any startups before. So for them, it was the first time investment, and many of them from the old industries, or lawyers, or real estate professionals, etc. Because they said that in the early stage they don't know where to invest, because it's like it's a girl and a dog in a garage kind of. It's like an idea. So which one to pick? But in this case, we can already show that these are the real companies, real revenues, real metrics, and many times they're using the products themselves. For example, most of the people have Aura Ring, so They know what's this. It's in our portfolio. It's easier to resonate, and they understand the risk much better.
That's a logical value prop or pitch. We can give you access and exposure to startups and venture asset class without, having to pick startup winners, which is really hard at the early stages. Yeah, that makes sense.
Exactly.
Let's talk about just for a second. Then I want to shift gears in a second to raising capital for raising the fund, but maybe talk about some of the startups you're seeing and that you've done. You mentioned in an email, Bolt, the Oura Ring, Booksy. What else are you? Broadly speaking, what are you seeing in the Nordics and CEE region, and maybe some of your more interesting deals? Yeah.
I mean, it's really from wide range of verticals. I mean, from space tech, for example, we have ISI in Finland, which is already revenue-wise hundreds of millions in revenues. They have contracts with the governments, they have contracts with the insurance companies, and so on. Really delivering super awesome service. It's a micro satellite service which can see details on the ground, no matter whether it's night or there's a clouds. And this is a super important, and especially at this kind of a geopolitical environment when the U.S. administration is kind of sometimes giving mixed signals. And then there was even at one point a week where ISI was the only one who was delivering eyes to the Ukrainian army at the ground. So this matters a bit. But so that's one end. But we have edtech companies like Preply, also kind of probably used in the US as well if you want to learn language. So as an adult, one option is Duolingo, but this is like a computer interface or kind of a mobile app compared to Preply, where you have one-to-one mentoring with somebody who can teach you the language. So also in the hundreds of millions of revenue, growing super well, and these are interesting targets that we're looking at, and we have been stalking for some time. But definitely there are up and coming new ones. Also a hot area like AI. I mean 11 labs known already. Also, I think in the US, which is kind of leader in the voice AI field, originating from Poland, already in billions in revenues. In evaluation, we need to monitor the new and upcoming stars as well, and be ready when the time is right to enter those companies.
I was going to ask, are you seeing a lot of AI stuff, and are the valuations kind of more reasonable than Silicon Valley AI valuations, or?
It's tough. I mean, for a secondary investor, it's tough to swallow those. So we need to be cautious in that. And if we see that it's too inflated for our taste, then we might not do it. But if the growth is there, it's growing strong, it has the moat, then why not do double down? Especially when you have a portfolio of different companies in different verticals, different geos, then why not to have some kind of maybe a bit riskier bet as well in the portfolio.
Yeah, interesting. Okay, I want to get into raising the fund, talking about that, but actually just before we get there, what's the quick backstory? How did you're on fund 2 now, but how did you come up with this concept to begin with? What were you doing before? And the genesis story.
I'm a former founder, so I've done my own kind of a full journey in this space with a successful exit. And after that, I was kind of sitting and thinking what to do next. I did some kind of a shorter term gigs, mentoring startups on short term, a bit longer term places, did some angel investing. And in the local angel network, I met my current partners. And we kind of both saw the same thing, what is happening, that at one side, Estonia was getting quite hot in attracting foreign capital to invest into the Estonian startups, because we had so many success stories. We have Skype, we have Wise, Bolt. We have 10 unicorns out of Estonia. We have only 1 million people living here. So we're competing with Israel through capital basis on producing unicorns. And
That's amazing.
and this was noticed around the world. So the valuation started to climb, and it was hard to get into the best startups. But at the same time, some fellow investors approached us and they said, "Well, maybe you want to buy a small piece of my investment that I did a few years ago. It's doing great." And I think in 2018 we did the first transaction in Bolt, the ride-hailing unicorn, kind of Uber competitor in Europe. And we saw that even if it's at a 1 billion valuation level, there is somebody who wants to sell, somebody who wants to buy, and just that doing it on a SPV basis, deal by deal, it's quite tiresome. So why not do kind of launch a fund and do it more properly. We tested out the concept in the ecosystem, both with the founders, with the angels, and so on. We got a lot of positive feedback, so we said, okay, let's try it out and see where it takes us. And overall, over my career, I've always liked to be in the blue ocean, not in the red ocean, if you know the concept. Strategy concept. So you rather be there and create your own market than be with all the rest of the guys. So if I would launch a new early stage fund, I would be yet another one. I don't have the I wouldn't distinguish myself so well. But in this secondary market, I'm probably one of the few or the only ones.
Yeah, very cool. Super interesting. Let's talk about, I guess let's go to Fund 1, because that's probably most of our audience who are VCs are raising Fund 1, but I do want to get to Fund 2 as well. But talk about putting together Fund 1. Where did you source LPs from? Yeah, and how big was that fund?
It was 15 million was the kind of main vehicle, and then we had some SPV vehicles down the line as well. So altogether 20. But it's grinding. It's you have the network already. Either in the startup ecosystem, the founders, the early employees who have already done secondaries, they have cash, so you can approach them. You approach some local family offices. You go for the business angel networks. Basically, the first round of capital came from like in any startup, I would say FFF. Somebody who really believes in you as a person, and you basically what you need to do is to pitch a story really kind of not kind of a too high level that we will do this 10 investments, but only say that okay, we will go and try to do this one deal, this particular company. And as this was a super hot company, everybody liked it. And we managed to do the deal. People saw that okay, they are trustworthy. They can deliver, and it wasn't a bad thing that after a couple of months there was a huge up round coming up, so valuations went up, and the people noticed that what we are doing. So there were more and more kind of people starting to jump on board. So yeah, number wise, I mean I think in Fund 1 we approached more than 600 investors, and then we got 80 or 90 of them on board. So roughly, let's say 15% hit rate, which is not too bad, I would say. Not too bad.
Yeah, no, that's great. That's great. And I I actually love stories like this. Like we pitched or approached. Did you approach or pitch? Maybe it's kind of the same, but I love stories like this where, you went after 600 investors, that just to give people some understanding of what it really takes.
Yeah, true. Well, I wasn't thinking when I started out that I would go for 600.
Yeah.
And then, but then at the end, I was looking at the numbers. Wow.
Yeah, that's a lot. I mean, but that's but still, that's like you said, 15% hit rate. That's actually pretty decent. I guess let's go to Fund 2, which was a larger fund, and you mentioned 100 plus LPs. Maybe talk about the journey getting there. You got Fund 1 and you got in some interesting companies. You got into some interesting companies. Had you had those first fund run companies go public and
No, not yet, but there has been a merger which delivered some TPI as well. So it didn't hurt. And also it didn't hurt that we have several companies which have done well. So I think 3-4 companies which where we have done a pre-4x. So in total, if you look at the TVPI, RR, TPI, all those numbers puts us into top decile of PC funds from the 21 vintage. And I think the numbers help to kind of convince institutionals to kind of back us as well. But basically, the numbers show that we're doing good job. So we decided, okay, we want to grow. So that's obvious. When you're doing well, so you want to grow. But if you want to grow, you cannot continue to do the same approach as you did before. So we had, close to 90 investors in the fund one. If I want to triple my fund size, 300 investors. That's a lot of legwork. It's really hard to do. We understood early on that we need to step up in the game and go for the ones who are chipping in, let's say 10 million or so. And so we did an early approach to EBRD, that's the European Bank of Reconstruction and Development, and also to the Estonian Sovereign Wealth Fund. And it took really a lot of time and effort and a lot of legal fees as well to finally reach there, but we did it. So they are the kind of a cornerstone investors in Fund 2, plus continued support from the Isomer Capital, which is one of the best VC fund of funds in Europe as well. And then the rest is still going for the private investors as in Fund 1. So once you have this kind of a big chunk of capital as a bottom, then you can much easier to build on top of that as well.
Was one of those three your anchor investor, or who'd you land first? Or I guess those are two separate questions, but yeah.
Isomer Capital, as they were in Fund 1, so they already understood what we're doing. We had done some co-investments together, so we have really good relationship with them. And then so they were ready to kind of chip in with the first close. And then the others kind of followed on. The IC decisions were made already, but it just took a bit of administrative legwork to get the LPA amendments done. So that's why the kind of delay from their side.
How big was Fund 2? Do you have that announced or public? Is it public information?
50 million is the target size. Yeah,
50 million. Gotcha. Cool. And are you able to disclose what Isomer did? Like how much of that is an anchor position, so to speak?
Well, they were in the first close. They were in low single digit of millions. But then the major lead investors who came later, they both chipped in 10 million.
Okay, gotcha. And okay, because this is really interesting for emerging managers thinking about Fund 2. Was it the Estonian Sovereign Wealth Fund or some other sovereign wealth fund?
Estonian, yeah. Estonian,
okay. Yeah.
So that's a kind of a local state or government-backed fund of fund that invests into other VC funds. And they are not investing only that we are from Estonia. They're actually investing all across the board. They have been, the latest news was that they just invested into one Swedish fund. They have invested some other pan-European funds as well. So they're not limiting, the mandate is not limiting only that we're from Estonia.
Interesting, yeah. Is there anything kind of unusual or unique about pitching a sovereign wealth fund or about the process, either about the pitch or the process? Or I guess I could also ask this for other emerging managers. Do you have any tips for going after a sovereign wealth fund?
I would say that build a relationship. I think that's the thing that usually there's like the formal process that you need to go through. But I think more important that you had the relationship already in advance still, so that you have pitched the ideas and talked about what you're doing, what value you're creating. And it's not about the sovereign. And for example, with EBRD, it was the same. We have to kind of talk what we're doing and see whether it resonates. So, and if you see that there is a spark in their eyes, and they see that okay, there's some interest, so maybe it's wise to kind of follow and continue with a more formal process as well. So I think, yeah, building the relationship in advance is important, not the formal process. So if you just go and send your pitch deck formally, then it's they have tens of them coming in. So why you are different? So it's a relationship building.
Sure. Yeah. No, this is one of the hard parts about it all is like, you're thinking about fund two, like, okay, great, build a relationship with a sovereign wealth fund or EBRD, but how do you sort of do that? Any other little microscopic things?
It's
Buy them coffee, I mean, what does that mean?
Oh, I mean, for EBRD, it was as simple as that. I mean, we were at the same conference. I went to the guy and said, "Well, we are doing this interesting stuff. Uh, how does it resonate with your mandate? Do you see that we're solving a real problem here on the ground, and do you see value what we're building?" So I think approaching on those events is totally fine, and that's their job. That's why they are visiting those events as well, to meet new managers. So the first contact definitely on those events, and and then keep them in the loop, and revisit in some other events, and engage with them. So there's not so much different. I think
Yeah.
being positively proactive, that's the thing.
Even that little phrase, what you just said there, we are doing interesting stuff. Here's why we're solving a problem. How does it resonate with your mandate is actually just a nice little phrase there, right?
Exactly.
Yeah, yeah, for
Exactly.
sure. What do you have any tips or favorite events? You mentioned like meeting these guys at events. What are
Mhm.
some of your favorite events you go to or recommend going to?
I mean, in this region, the Nordics and the Central Eastern Europe, what I like the most, and which provides also as a platform to engage with really all sorts of variety of LPs, is a Slush. It's a conference organized in Finland at the end of November, and they managed to bring more than 100 LPs across the world to really dark, slushy, snowy,
Yeah.
and cold Finnish capital. And what is important is that people just don't come there, but they actually like to network. There's a platform, digital platform. They are building the connections so that people are actually answering to the mails that you're sending through the platform, which is not so typical in some other conferences, like, I don't know, Superventure or so. Nobody uses the digital platform. You need to be kind of physically there and engage with the people. But with the Slush, I like that it's possible to kind of speed up the process. You can send I don't know 50 outbound messages and see okay who replies to you, and you can also not to send to everybody, but they have the kind of criteria in place. LPs need to put that okay, I'm investing only emerging managers. I'm investing only Fund 5 and beyond. I'm doing 1 million ticket. I'm doing 20 million plus tickets. It's easy to understand. Okay, these are the big boys. I don't want to mess with them. I don't need to waste my time. Okay, these are more important for us. Let's focus on them.
Yeah, that's interesting. It's funny, I owe the Slush guys an email. They're trying to get us as sponsors for their LP event, and it sounds awesome. It's also very expensive, so I need to think about that. But that's very interesting to hear that, right?
But
Um,
it's one of the best ones in this version. Definitely,
yeah,
really
yeah,
recommend.
no doubt. Very cool. All right, I won't keep you much longer, but for this fund two, you raised from Isomer, a fund to fund, a sovereign wealth fund, and the EBRD, the European Bank for Reconstruction and Development. Sounds like a development bank. Does your pitch differ between those three audiences, or is the pitch pretty much the same? Like, how much do you have to tailor your pitch for the audience for those different big LPs?
Yes. I mean, a fund of fund. They're a typical, I would say, private investor. So they want to see the returns and the performance metrics, and what else was important, that they wanted to see the kind of co-investment deal flow as well. So which is totally fine for us. With the state-backed fund of funds, or EBRD, which is a development bank, and they they want to see returns as well, but one of their kind of criteria is what is the socioeconomic impact, and you need to understand what are their kind of objectives, what they want to achieve. So besides the financial returns, they want to have some impact in the whole society. So how you resonate with that, and what value you're bringing on table on top of the cash.
Yeah. What's your answer to that? I mean, it's usually that's
Well,
like, how do you create jobs in the region? But you're
exactly,
secondary. So what's the
exactly.
answer?
That was kind of hard sell. That, well, the jobs created is not the most important in our case. It's we were pitching that I mean, EBRD and the SmartCap, well, they both want to help the capital markets to develop. If the IPOs are getting longer, I mean, the cash is locked in, or the investors cannot invest in the new places. So if the capital is flowing more freely and faster, it helps to speed up the tech flywheel. So that's important. So the investors can reinvest the capital into newer projects. And also, what is important, that there's a kind of other secondary flywheel effects, that some talent is, for example, there's some early employees who have left. They sell the shares. They can get capital. They can launch the new startups. What else we have seen is that some guys have launched the new VC funds, use the money for the GP commit. So there's several kind of positive socioeconomic positive aspects that we are seeing already. For example, we asked from our counterparts, have you invested back into the ecosystem? 70% said yes. So they just don't buy the cars and the houses and yachts. They understand the startup the life, and they want to back other guys as well. So that's why basically we help to speed up the whole flywheel. That's what we're doing.
Good answers. I like those. I'm sold. You got me. Very good. All right. Well, I won't keep you any longer. This is all very interesting. If people want to learn more about what you're doing, it's Siena.ee. That's Siena.ee. Is there anything you want to call attention to, or plug, or mention, anything at all?
No, I mean, just hit the website, or just connect me in LinkedIn as well, and put some message. If it's a cold one, then I might not reply, but if you put some message, then happy to reply and engage with fellow GPs, LPs, or founders.
Very good. Well, thank you for your time. This is super interesting, and I think it's a clever model, and it's pretty cool what you're doing. So hope to see you after fund number 3. We'll see how the model's shaped up or changed, if at all, and what some of the cool things coming out of Estonia and the Nordics are looking like at that time.
Super. Thank you for the time, and see you in Tallinn or in Helsinki in Slush.
I hope so. We're working on it. It's yeah, we might be a sponsor there, or maybe we'll go guerrilla style and just hit the parties instead.
Exactly. That's also a clever one. So
Yeah.
anyway, if we will come, then let me know.
Thank you very much. I appreciate it. Have a good rest of your week, and might see you in Finland. Over now.
Okay. Thank you. Take
Bye.
care.